Welcome to On Investors' Minds. I'm Kerry Craig, a global market strategist here at JP Morgan Asset Management. Thank you for giving us a few minutes of your time to hear about what's on investors' minds and how that fits in with current views on asset allocation. Now, today I'm very pleased to be joined by Helge Skibeli, a portfolio manager and a lead portfolio manager when it comes to core global portfolios in our international equities group. Now, while usually based in America, Helge is out here in Australia this week meeting with clients, so very fortunate to have his time. Helge, thank you for joining us today.
Thank you. Thanks for having me on, Kerry. It's great to be back in Australia.
Well, there's plenty of opportune time to be here given what's happening in markets and what's happening in the world with the macroeconomic environment. So I have a whole host of questions here to go through, but I think I'm going to start with the big one when it comes to what's happening in the Middle East. I guess the market seems to be, discounting what is the worst case scenario coming through. We have seen the markets continue to move higher. Now, some clients I've spoken to recently talk about, complacency in the market. Do you think that, equities and investors are discounting too much of the risk that's really there and there's been too much of chasing momentum in the market? Or is it simply the case that, investors are looking past this geopolitical event and thinking more about the fundamentals of the companies?
Yeah, that's obviously a big question right now. But first, let me sort of just step back and describe who we are. So at JP Morgan Global Equities, what we do is, first of all, deep industry analysis. We try very hard to identify long-term winners and losers on a company basis. And on top of that, we layer on sort of a disciplined valuation approach based on discounted cash flow. So that is to say that we are very sort of bottoms-up stock pickers, and we sort of have a preference over micro over macro, basically. So to your point, there's a lot of focus right now on Middle East, oil prices, where is all this going? And as you say, there is also an underlying earnings recovery. There's a cyclical recovery going on. So the big question is, will this be derailed by the oil price? And the answer is, it's hard to say because we don't really know when this is going to end. We don't know whether oil price is going to stay high here around 100 or go down. It depends on how long the crisis, the Middle East, will last. On the top of that, we also have a very complex, I would say, environment right now because of all the controversy around AI. So all of this real sort of uncertainty is also leading to high price momentum in the market right now, which is also challenging. So therefore, I would say our focus here is pick stocks where we have a real valuation signal and where we also have a real insight advantage. So right now, I prefer to emphasize the micro over the macro. So I'm not making a call on this oil prices. It's just too hard to tell. It is possible that the oil prices stay high. In that case, I don't think we're going to get a cyclical recovery. If the oil price comes down, we will. So therefore, emphasize stock selection over making that macro call.
Yeah, there's certainly been a lot of scenarios being analysis at the moment, thinking about what we'd form as a base case was eventually you get some sort of resolution to the Middle East crisis, but being very aware of the tails to that outlook in terms of just the news flow and how the market's reacting to any indications there could be further talks versus an escalation in the conflict. You touched on something else there I wanted to talk about. You talked about the cyclical recovery in the earnings, and again, a question that's come up a lot and that we've seen is that over the last few weeks, you've actually seen earnings revisions continue to move higher, which is a little bit surprising as you think about the downside risk to higher input costs, squeeze on margins, or even a lower demand outlook. So, why, from a bottom-up micro perspective, are we continuing to see earnings expectations rise in this environment?
Yeah, that's another great question. Where are earnings going? So if we step back again for a second and think about where earnings are coming from, we had a huge peak in earnings and in margins in particular during COVID that at the time I thought was very unsustainable. Now, outside of tech, we've gone through 3 years of hangover from COVID with margins correcting downwards. And we have had pretty much zero earnings growth outside of big tech, where all the action has been taking place. Now we are really starting to see some green shoots. I think we have a broadening industrial recovery. We're seeing capex beyond just data center. We're seeing some good signs in the financial sector. Strong M&A, IPOs coming, really big IPOs coming with SpaceX, for instance. And loan growth, if you look at loan growth in the first quarter for the big US banks, was actually really, really strong. And commodities markets, commodities outside of oil and gas are actually also strong. So yes, there are some actual positive cyclical signs here. So if you look at it regionally, clearly we think, the strongest action is in the US. We're kind of thinking 15-20% earnings growth this year, but also internationally, we're seeing signs are picking up. So globally, we're clearly going to have a double-digit earnings growth year this year if oil prices don't derail all of this. So I think it's fair to say that tech will still have the strongest impact on earnings, but we are broadening out. But we need oil prices to go down.
Yeah, as was the case, I think, obviously, going back a year ago after Liberation Day, the recovery rally was really, or the relief rally came in that AI tech theme before broadening out across other sectors. And it's kind of whether we'll see that same play again, but now we have a lot more pressure on the consumer potentially coming through. Nice little segue, though, into my next question around the AI side of things and thinking about that capex investment coming through. Before we had the conflict in the Middle East, at the start of the year, the questions I was getting from clients was around elevated valuations in the market. The multiples on PE, particularly in the US, were very elevated. And then we had the sort of concept of AI disrupting a lot of business models in terms of the software as a service model, or just the advancements and the pace of advancements we were seeing in AI and how they could disrupt a lot of those capital-light business models. So I wanted to dive into those a little bit more. Starting with valuations, I mean, we had a derating, things are starting to creep up again. What are your thoughts on valuations across equities at the moment?
Right, so if we look at the world stock markets, I think actually we are around fair value, maybe a little bit above, but not that much, I think. But again, this is highly dependent on that earnings picture I just talked about. So if we don't get that, I think markets are not cheap. If we get that 15-20% earnings growth in the US and double digits globally, I think markets will hang in there and can grow with earnings. But again, our preference is to look at the internal. So let's start with the regional picture, US versus international. To your point, there's been a lot of discussion about that. And international equities have been doing better over the last year. But if we compare the growth outlook, including this year, and also the secular growth outlook for the US is clearly better. And that's largely driven by tech, I think. And then also looking at free cash flow generation, it is superior in the US, despite all of the data center capex build-out, is still really superior. So if we adjust for growth and free cash flow generation, we still are finding a lot of opportunities in the US. So we don't really have a clear preference. We're also finding great opportunities international, but I wouldn't say we prefer international over US here. Then if you look into high growth versus low growth, over the last 6 months or so, you've seen a lot of correction in tech. Okay, there's a lot of controversy as well, but we're clearly seeing stock selection opportunities in tech these days. And then within cyclicals, as I mentioned, there is a recovery coming, and we're finding some really decent opportunities, both within financials and industrials here. Then defensives, clearly we see a valuation opportunity in defensives. We think defensives are cheaper than cyclicals. So we're also seeing opportunities there. So it sounds like I'm saying we're seeing a lot of opportunities globally and with all areas, defensive, cyclicals, and tech. So it's a really rich environment for picking stocks right now, I think.
Yeah, you've seen valuation dispersion on the global equity index really start to widen out again. I guess that does present opportunities and active management, but that active management also involves controlling for those risks that you said. They're still out there. We're not entirely sure which way things will break when it comes to the Middle East. And it's a similar situation with AI. There's obviously a deal of hype that goes with it. There's a lot of uncertainty around adoption of these models. How far they can go through in terms of enterprise adoption versus what you're seeing with the consumer. Is that AI disruption that we saw earlier in the year in terms of those business model? Is that something you're focusing on, or you mentioned the capex build out? Is it the AI opportunity on that side of things that most interest you?
Yeah, right now this is a huge focus for us. It's really the most important issue that investors are facing right now. So if we think about tech and AI, my preference is to sort of divide it into three buckets right now. So first of all, the AI enablers, as I call them, the picks and shovels, and that's semis. These are the very companies that are making all of this possible, and I think they have a very long runway for growth. So that is my preferred area right now. Then my second bucket would be hyperscalers. And there's a lot of controversy around hyperscalers right now because the huge capex build out that we're seeing. So the question is, will they generate a return on capital or not? What we are seeing is that they can really drive their revenue growth at a much faster pace and generate a real economic return on this spend. So we think this is for real, and we think it's good spend rather than a waste. But the big question is, can they start generating free cash flows again? So they clearly need to slow down the growth of this spend such that free cash flow margins are going up again. Once that happens, and we think it will over the next 2 to 3 years, then these stocks are really going to work, we think. So to the last bucket, software and other digital services, this is the real epicenter of the controversy, and this is where all the AI losers live today. This is admittedly a much harder area to have real insight into right now. There's a wide range of outcomes, quite a lot of uncertainty, so we tend to be underweight that part of the market right now.
Yeah, I think that uncertainty was best reflected in terms of just some of the indiscriminate selling across other names that weren't necessarily related to software earlier in the year, some transport companies, etc., that were being hit by the prospect of having their practices disrupted. So certainly it's an area of focus. I mean, the performance you're seeing in the semis, I think, speaks for itself at the moment. But as we talk about AI, obviously we're thinking about the investment side of things in terms of generating returns in a portfolio. What about the other side in terms of how you yourself and your equity analysts are using it to actually think about investing in terms of internalizing AI into the process?
Yes, the answer is we're using it extensively and more. So, which is part of the reason we have so much conviction that this spending is good spending. We are using it extensively now, both within portfolio management function and research. And we can see how we can utilize data analysis to a whole different level than we have before, and also making the research function far more efficient than it has been before. So when we just look at within our sort of area within asset management, how powerful it can be, then I'm a huge believer in AI.
Yeah, I mean, it's something we continue to see levels of investment within JP Morgan continue to rise. The sophistication of what the models can actually do internally in our own platforms seems to get more impressive every time I see it being demonstrated. And I think the sophistication of these models is continuing to ramp up when we look at what's coming out from the big AI architects. I wanted to come back to some of that view around cyclicals and defensive. So another thing that is obviously capturing attention with a bit of a concern around which way things may go, some of those tail risks in the market. The reason cyclicals have been performing so well, even though you're seeing growth expectations being downgraded in the US, small caps have been doing very well as well. Again, we get concerns around, if there is this potentially bearish outlook, why not lean much more into defensive and higher quality companies rather than taking sort of a views on cyclicals and financials and the fact that, lending growth may be curtailed in that environment?
Yeah, another great question, Kerry. What I would emphasize here is that so that we are in an environment of extreme uncertainty. And yes, there is a real advantage on the valuation side for defensives. On the other hand, if oil prices go down, if there is a solution in the Middle East and we get a strong cyclical recovery, you may not want to lean too much into defensives.
On the consumer, the data is yet to show a significant downturn in terms of the spending habits. Maybe still to come, but it seems like in the US, the consumer just continues to spend regardless of what the environment is. So those questions around how sensitive they may be in terms of the different household income groups to these higher energy prices still to come through. And another question, again, bottom up, you're not having a regional allocation so much because you're just looking for all the opportunities around the world, or what's available in the global equity index. But we did see that rotation a little away from the US. It wasn't the end of US exceptionalism, but certainly the valuation sort of drew people towards emerging markets, towards Europe, and a little bit away from the US. That seems to have reversed a little bit more recently. Are you seeing shifting attitudes towards US equities, or that persistent trying to rebalancing of away from the US that's been so dominant for a few years?
Yes, we have seen signs of that. Again, as you hear from me, I'm a global stock picker, and in my mind, the question isn't US or international per se, is to find the best opportunities worldwide. We're finding great opportunities in Asia, in Europe, and in the US. So, as I have alluded to throughout this conversation, both within cyclicals, defensives, and high growth, we're seeing great opportunities that, yes, there's a lot of controversy and risk in the marketplace today, but that also creates a real opportunity across a broad set of securities today.
Fantastic. I have one final question, Helge, which I think I'd be remiss if I didn't ask, given your experience and your tenure at JP Morgan, both across equity research and leading that, as well as being a portfolio manager on the core global portfolios, but not your first time having to lived and been an investor through one of these big geopolitical events, or even a financial crisis in the markets. What are the things that you look towards to keep yourself, I guess, and your investments sort of grounded and on track in these kind of environments?
Yes, another fantastic question that I really love. I've been around for a long time and I've seen other extremes. Let me mention a few. The dot-com bubble, 20, 25 years ago. The GFC happened a decade later than that. And then COVID. So there have been so many extremes just the last couple of decades. And each of them, I would say, bring unique challenges, but also there are real similarities. So there's a lot of learning here over the years, for sure, being through several sort of extreme environments. But what's key to us is that we always need to stick to our core beliefs. We always need to stay disciplined. And, to us, that means, again, as I mentioned several times already, it means focus on stock selection, where we really have a strong research advantage. So it starts with valuation signal. That always comes first with me. If the long-term valuation signal is in place, I'm interested. And then I need a real insight advantage. So as we talked about, we may not have that amongst the AI losers right now. So that's an area where I tread more lightly. But if I have that combination between strong valuation and a real insight advantage, yes, then I also have conviction. So valuation, conviction, insight, that's my guiding light, basically. So layer on top of that, risk management. We want to stay diversified. We don't want to lean too much into any kind of macro scenario, and have a diversified portfolio across sectors, regions, and factors. So the micro rules over the macro, in my view.
Yeah, as someone who works in very much a top-down view of the world, macro, we tend to go the other way. But I think the key things I heard there were about trusting the process, something that works well and is repeatable, continue to be disciplined within that process, and obviously diversification being the key thing when we think about investments overall. Helge, fantastic conversation, and thank you very much for your insights into how you're seeing the world and joining us on this podcast. Thanks to our audience for listening. If you did enjoy this podcast, please share it with your colleagues or consider subscribing for future episodes.
Thank you so much, Kerry. It was great talking with you today.
Thanks, Helge.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.